Ever wondered how to invest your money wisely? Well, you've come to the right place. Today we're going to introduce you to the concept of investing and why it's a crucial aspect of financial growth. Imagine for a moment a tree. This tree represents your financial future. The seeds you plant today with time, patience, and the right care can grow into a mighty oak. That's investing in a nutshell. It's about planting the seeds of your wealth and nurturing them over time. But what seeds should you be planting? That's where investment vehicles come into play. Think of them as different types of seeds, each with its unique growth potential and risks. And today we'll be talking about three of the most common types: stocks, bonds, and mutual funds. Stocks, the first of our investment seeds, represent a share in the ownership of a company. They're a way for you to participate in a company's success or failure. If the company does well, your stock may increase in value. If not, it could decrease. There's potential for high reward, but also high risk. Next up, we have bonds. These are essentially loans you give to a company or government entity. In return, you'll receive interest payments over a set period, plus your initial investment back at the end of the term. They're generally seen as safer than stocks, but the returns might not be as high. Finally, we have mutual funds. These are a collection of stocks and bonds managed by a professional fund manager. It's like a basket of different seeds, giving you a bit of everything. They offer diversification and professional management, but they also come with fees and potential for underperformance. So there you have it. 3 seeds to potentially plant in your financial future. Each carries its own risks and rewards, and understanding these is key to investing wisely. Stay tuned as we delve into the world of stocks, our first investment vehicle. So, what exactly are stocks? That's a question many aspiring investors ask, and today we're here to answer it. Think of stocks as a slice of a company's pie. When you buy a stock, you're essentially purchasing a small piece of a company. This makes you a shareholder. As a shareholder, you own a fraction of the assets and earnings of the company, and you might even get a say in some of its major decisions. Now, why would you want to buy stocks? The simple answer is growth. Companies are always looking to expand, innovate, and increase their profits. As they do so, the value of your stocks, those little slices of pie, can increase. This growth can potentially provide you with high returns on your investment. But it's not all sunshine and rainbows. Investing in stocks also comes with a fair share of risks. The value of stocks can fluctuate, sometimes quite dramatically. One day, your stocks might be worth a lot, and the next, their value might plummet. This is why it's crucial to conduct thorough research before investing. Understanding the company, its business model, and its potential for growth can help mitigate these risks. This brings us to the stock market. It's like a gigantic supermarket for stocks. Buyers and sellers come together to trade stocks, setting the price based on supply and demand. The stock market plays a pivotal role in the world of stocks, acting as the playground where all the action happens. Now, stocks might seem intimidating at first, but with a bit of knowledge and understanding, they can be a powerful tool in your investment arsenal. The potential for high returns makes them an attractive option for many investors. However, never forget the importance of research and understanding the risks involved. Up next, we're going to explore the realm of bonds. Keep listening. Ever heard of bonds but not sure what they entail? Well, let's lift the veil on this intriguing investment vehicle in the simplest terms. When you buy a bond, you're lending your money to an entity, be it a corporation or a government. It's like being a bank, but without the bricks and mortar. You're the creditor, and they are your debtor. They promise to pay back your loan with interest over a specified period. Now, this interest, also known as the coupon, is the income you earn from bonds. It's usually paid semi-annually until the bond reaches its maturity date, which could range from a few months to more than 30 years. The best part? You're guaranteed to get your original investment back, assuming the entity doesn't default. Speaking of default, let's talk about safety. Generally, bonds are considered safer than stocks. Why? Because even if a company goes bankrupt, bondholders are paid before stockholders. But don't be fooled. Bonds aren't risk-free. The entity you lend to could default, leaving you high and dry. That's where credit ratings come in. Credit ratings are a measure of a bond issuer's creditworthiness. They're like a report card for entities. Ratings agencies like Moody's, Standard & Poor's, and Fitch assign these grades. The higher the rating, the lower the risk of default. But remember, lower risk often means lower returns. So there you have it, bonds in a nutshell. They offer a steady stream of income and provide a cushion against the volatility of stocks. But just like any other investment, they come with their own set of risks. Understanding these risks and the role of credit ratings can help you make informed decisions. With bonds under our belt, it's time to move on to mutual funds. Don't go anywhere. Now let's turn our attention to mutual funds. Imagine having a basket, and in this basket you have a mix of different fruits, apples, oranges, bananas, and so forth. Each of these fruits represents a different type of investment, like stocks or bonds. This is essentially what a mutual fund is, a collection or basket of various investments. At the helm of these funds is a fund manager. This individual, or sometimes a team, has the responsibility of deciding what goes into the basket. They research, analyze, and select the stocks and bonds that they believe will perform the best. One of the main advantages of mutual funds is the opportunity for diversification. Instead of putting all your eggs in one basket, or in our case, all your apples in one basket, you're spreading your investments across a wide array of assets. This helps to mitigate risk. If one stock doesn't perform well, it's not the end of the world because you have investments in other stocks that might be doing better. Now let's talk about the potential for steady growth. Mutual funds, by their nature, are designed to grow over time. By pooling your money with other investors, you're able to participate in a wider range of investments than you would be able to on your own. This opens up the potential for higher returns. Lastly, it's important to understand the difference between active and passive funds. Active funds are those where the fund manager is actively making decisions about what investments to include in the fund. Passive funds, on the other hand, aim to mimic a specific index or benchmark, and the investments are chosen automatically based on that index. So, there we have it. Mutual funds are a versatile and accessible way to diversify your investment portfolio, with the potential for steady growth under the watchful eye of a fund manager. Now that we've covered all three investment vehicles, let's wrap things up. Let's recap what we've learned about these three investment vehicles. First up, we have stocks, a type of investment that gives you ownership in a company. Purchasing stocks means purchasing a piece of that company's future earnings and assets. It's like betting on a horse, only this time, you're betting on the company's success. Stocks can be volatile, with prices fluctuating based on the company's performance and market conditions. But with higher risk comes the potential for higher returns, if you've placed your bets wisely. Then we have bonds. When you buy a bond, you're essentially lending money to a company or government. In return, they promise to pay you back with interest over a certain period of time. Bonds are considered safer than stocks, as you're guaranteed to get your money back unless the issuer defaults. However, the potential returns are typically lower. Next up, mutual funds. These are a collection of stocks, bonds, or other assets managed by a professional. Instead of putting all your eggs in one basket, mutual funds allow you to spread your investment across a range of companies or sectors. This diversification reduces the risk, but it also means the potential returns are spread out. Plus, you'll need to account for management fees. Each of these investment vehicles has its own set of potential risks and rewards. Stocks can offer high returns but come with a higher risk. Bonds are safer but offer lower returns. Mutual funds offer diversification and professional management, but they also come with fees and potentially diluted returns. But here's the key takeaway. Don't put all your eggs in one basket. Diversification is crucial in investing. By spreading your investments across different types of assets, you can reduce the risk and increase the potential for steady long-term growth. Remember, investing wisely is about understanding your options. Thanks for tuning in.